fabulously rich within the first year or two of these operations. Then, of course, because it is, in essence, a Ponzi scheme, the whole thing is going to collapse. But the failure of the firm doesn't mean that the fraud scheme has failed. The CEOs can still walk away incredibly rich and with their reputations intact because they blame the failure not on anything they did, but, well, there was a bubble and everyone got hurt. Instead, of course, when you do many of these same kinds of frauds at the same time, where you're lending lots of money to build lots and lots of these commercial office buildings in the same city at the same time, you are guaranteed to produce a huge financial bubble. And that's what these epidemics of mortgage fraud create.
Great answer. Anything else that that you'd like to say, or that you think would be useful to people who are interested in monetary reform?
Well, I'll say something not directly related to monetary reform, but I have folks here maybe, and that is what I've been discussing has been in the realm of finance. But the control frauds also occur in the realm of quality. So a great example of this is the Chinese infant formula scandal. And what that involved is the people making formula for infants took all the milk out and substituted water and chalk to make it look like milk. Why? Because it was a lot cheaper. And they gained a competitive advantage because of that. China searches for this kind of fraud by looking for protein levels. So these frauds added melamine to the infant formula because that spoofs the protein levels. So now you have a product that has zero nutritional value for infants who most desperately need nutrition, and on top of that has a poison, melamine, that screws up their kidneys. When cheaters prosper, they drive honesty out of the market. And that occurs not just in the financial sphere, where most of us have been talking, but this happens in other spheres that also maim and kill people. So we have to change this entire dynamic, not just in finance, but elsewhere. Because if cheaters prosper, we end up with the worst possible system, and to call it a free market system is an obscenity.
Any particular short suggestions on how to do that?
The way you stop those kinds of frauds are to make sure cheaters don't prosper, right? So you have real regulation that looks at the quality of products that people are going to have. You take that off the marketplace immediately, and you imprison for 20 or 30 years or more the people who would be willing to profit by killing and maiming infants. And the reason I use this example is to point out how badly ethics can be run down when you create the wrong financial incentives. Effective regulation, whether it's in the monetary sphere or in product safety, is not the enemy of honest producers. It's the only thing that allows them to compete against what would otherwise be the most fraudulent competitors that would drive them out of business.
The re-regulation of the savings and loan industry occurred under Ronald Reagan, very much over his soon-to-be-dead body, type of thing. And we were universally hated by what was then one of the most powerful trade associations in America. A majority of the members of the House co-sponsored a resolution saying not to go forward with re-regulation. 5 U.S. senators became known as the Keating Five. Speaker Wright, one of the most powerful speakers of modern history, albeit for a relatively brief time, in part because of things like this, held our bill hostage to extort favors for some of the worst frauds in Texas. Keating, in addition to what you see at the yellow page where it's marked, sued me for $400 million in my individual capacity in what's known as a Bivens action, hired private detectives twice, to investigate me. And Speaker Wright, one of the proposed charges by independent counsel in the ethics case there was Speaker Wright's efforts to fire William K. Black, you know. So it was interesting times in that era, and you really saw how very powerful corrupt organizations could get aid from Congress at the absolute peak. So this wasn't stuff that Bill Black did. It was a team of folks that did it, and the leader was a Chairman Gray who had a road to Damascus experience conversion from being a Reaganite and came the great re-regulator. And by the way, he is unemployed and unemployable 20 years later. So there's a price that is paid. I'm certainly unemployable in the federal sector. But I am actually an associate professor of economics and law at the University of Missouri at Kansas City, and I'm a white-collar criminologist and, as you heard, a former financial regulator. And I'm going to be talking about the role of fraud, and the FBI warned that there was an epidemic of mortgage fraud in September of 2004. Note that date. Right? So all of these folks who tell you there was no way to know about it, there were no warnings, et cetera, et cetera, et cetera. This is nonsense. There were warnings, and they were public in congressional testimony. The FBI has also said that 80% of the mortgage fraud losses occur when lender personnel are involved in the fraud. So this isn't a story primarily of, you know, some incredibly poor African-American woman in Cleveland somehow defrauding these incredibly sophisticated folks. Quite the opposite. The numbers are extraordinary, and they're vastly worse than what I'm about to say. So in fiscal year 2007 and 2008, it grew from 50,000 criminal referrals to over 62,000 criminal referrals. These are only criminal referrals for mortgage fraud. In roughly this same period, a little longer, investment banks that dealt in hundreds of billions of dollars of this product managed to find all of 36 criminal events. We're going to explain why, but passing odd to begin with. Now, critical. The unregulated sector made 80% of the non-prime loans. The unregulated sector has no regulatory requirement to file criminal referrals. And the unregulated sector, a la the investment banks, essentially filed no criminal referrals for mortgage fraud. So you have to take this 62,000 number and multiply it by about 5 to even begin to approximate the number of acts of fraud in a single fiscal year. But that wouldn't do it. That extrapolation wouldn't come close to capturing the true incidence of fraud because, of course, many frauds are undiscovered for many years. The FBI estimates that at most 1/3 of them are discovered. And second, most times, even when it was a regulated entity, that's the ones, again, that made the 62,000 criminal referrals, even when it was a regulated entity and they found fraud, the most common reaction